Hello everyone, this is Dr. Zaidi. Welcome to my YouTube channel ZTU. In this video, I'll be discussing about flexible budget. So let's start with some terminologies here. Variances. What is a variance? Variance is the difference between your budgeted result and the actual result, or the expected result and the actual result, or the forecasted result and the actual result. So the difference between your expectation and your actual is known as a variance. Now we use variance for planning and control functions, right? We plan at the beginning of the period, whether it's the beginning of month, quarter or a year, we plan and then we try to control it. So every month, every quarter, we try to find out if we are on track or not. And as soon as we find out that we are out of track or we are diverging our direction, then we try to modify our plans and so we can get back on track as soon as possible. So if we have a sales budget that we have planned for the year, and at the end of the first quarter we find out that we are not reaching the sales quota that we are supposed to in order to meet our yearly goals, then we can modify our plan right then and there, before it's too late, before we wait until the end of the year and then and we are unable to fix the problem, right? So the control functions comes into play when we are diverging from our goals, so we can stay on track. So the variances are used to bring like planning and controlling functions together so we can make the better decision. It also facilitates management by exceptions. What is management by exception? It basically distinguishes between the allowed cost, normal variance, and extraordinary variance. What it does, it sends signal to manager whenever the extraordinary variance occurs, right? It sends signals to manager, the variance has occurred and it requires investigation. And then you can identify the underlying causes of variance. Now, so what is the normal variance then? What is the allowed cost and what is the extraordinary variance? Now that is determined by company. Now this can be determined based on the dollar amount or the pound or whatever currency you're using, or it can be determined by percentages, which is more appropriate. Why the dollar is not more appropriate or the currency is not appropriate? Because $5,000 is maybe significant for a company that worth only $100,000, but $5,000 may not be significant for a company that worth $1 billion, right? So the significance cannot be determined just by amount, because one amount can be significant for one company and not significant for other. So the better way to take this into consideration is assign the percentage, right? And you can say that, okay, if the variance is going to above 5% or below 5%, we are going to evaluate. So if it's a $10,000 company, it's 5% of 10,000. If it's a $100,000 company, 5% of 100,000. If it's $1 billion company, 5%, right? So we can find out a percentage or number, and then we can use it to find out whether the variance is an exceptional variance or it's a normal, right? If it falls below, like let's say you chose 5%, if it falls within -5% and +5% range, then can be considered as a normal variance and may not require significant investigation, considered as an allowed cost or allowed revenue. However, if it's an extraordinary variance that falls above 5% range, right, or below 5% range, or if you may decide to do 2%, not 5%, then above 2% or below 2%, then you need to find out what are the causes of those variances. Now, sometimes the causes can be fixed, sometimes the causes cannot be fixed, right? So for example, if the costs are going up, the raw material costs are going up, you don't have any control on that. You cannot fix it unless you buy poor, cheap quality material. Same as if it's the labor cost is going up, you cannot fix it unless you buy cheap labor, right? Which in case they may not be as efficient and not as trained. Okay, so some times the variances cannot be controlled. On the other time, if it was your error that you have, when you prepared a budget, you were not knowledgeable about budget and you made mistake, then you can fix it at that time, that okay, this was an error, that's why we had so much variance. We can fix it for the next quarter or the next year. So those variances can be fixed. So some variances can be fixed, some variances cannot be fixed. Sometimes the variances are caused by, because it's a poor machine, everything was good, but machine keeps breaking material and you end up using more material, which end up costing you more because you have to buy a lot more material. At the same time, you can also say that sometimes the labor is not well trained and they keep breaking material and they keep taking longer time, due to which your variance for labor would be higher, your variance for material could be higher, right? So those kind of things can be fixed by providing additional training to labor or buying quality material. So sometimes the variances can be fixed, the other times material cannot be, the variances cannot be fixed. So you need to find out what are the underlying causes and to fix them if they can be fixed. The purpose of variance analysis is not to penalize managers or the workers who have caused the variance. The purpose is to find out the causes and try to rectify the variance. And sometimes a good variance can be as bad or worse than the good variance, because a good variance can cause other variances. So for example, if you buy a material which is a cheap, so your cost should show lower, that, oh, you purchase material for a lot less cost. But on the other hand, when you buy cheap quality material, maybe the labor spend more time on working on material because material keeps breaking, so the labor cost goes up, or the production cost goes up because the material keeps breaking. Right, your quality control cost goes up because they keep sending material back to you for rework, or your um, um, warranty claims goes up. So they can increase costs for other departments. So sometimes the good variances can be as bad or worse than the poor or bad variances. So we have to be very careful about variances. So in this video, we will be discussing about static budget and flexible budget. What is a static budget? A static budget is also known as planning budget. It is prepared for one level of activity, one single level of activity. What is one single level? You can say that you're working towards producing 10,000 units, or you're working towards selling 10,000 units. So that's one level of activity. There could be other level of activity. Maybe you produce 11,000 units, maybe you produce 12,000, maybe you produce 13,000, maybe you produce 100,000. So there are several level of activity. But static budget is produced only for one level. You choose, you budget what you planning to produce, and then you produce all the budget based on that particular level of activity. And static budget comes with a lot of disadvantages, and this is the disadvantage, because your activity level may increase or decrease depending on various situations. So if you end up producing more than 10,000, producing less than 10,000, then your budget may not match, right? Your costs may not match because the activity level are different. So the static budget variance is basically a difference between what you budgeted and what is the actual results, right? Your actual results and your budgeted amount. That's the static budget, okay? Your performance evaluation for overhead is difficult when actual level of activity differs from planned level of activity, okay? Because you have planned some other level of activity and the overhead is driven by cost driver, right? And when the activity level changes, that the cost driver drives the cost, it can change everything, okay? So not only just overhead costs, all the costs that are driven by the activity level or certain activity level, whether it's labor hour, machine hour, and this can be affected, and it can affect your cost many more times. So here is the example of a static budget. So here is the static budget on your left column right there. The static budget says we are going to produce 20,000. So budgeted amount was 20,000. Remember, a static budget is made for one level of activity, 20,000. At 20,000 activity level, the material cost is going to be 80,000. Labor cost is going to be $60,000, and variable MOH is going to be 10,000. Depreciation on machine, which is a fixed cost, will be 10,000, and factory lease is going to be 5,000. So the total cost for producing 20,000 units are going to be $165,000. Okay, so that's the total cost. That includes your fixed factory overhead, right, or fixed manufacturing cost, and also include your variable manufacturing cost. Now the actual results show that you only produce 16,000. Now this happened only after the fact, when the period is passed. So you started, you budgeted for 20,000, but you produce only 16,000. So you automatically have unfavorable variance. Why it's unfavorable? Because you were unable to achieve the budgeted level of activity. Your budgeted level was 20,000, you produced less. So in terms of units, you didn't produce as many as you were supposed to. So that way you have an unfavorable variance. Let's see the other variances. So here the actual results show that your material cost was 70,000, labor cost was 50,000, variable MOH was 7,000. So if you look at that, you budgeted that your cost is going to be $80,000, but you came out to be $70,000. So you spent $10,000 less, right? Therefore, your variance is $10,000 favorable, F. Okay, so that favorable variance right there, because your actual costs are less than your budgeted cost. That brings your favorable variance here. Then 60,000 you budgeted, 50,000 is labor cost, again $10,000 favorable variance. Then you budgeted 10,000 and you variable manufacturing overhead is 7,000. So 10 minus 7, 3,000 favorable. You incurred less cost. Then because fixed cost doesn't change in the relevant range, so 10,000 you budgeted, you incur 10,000, 5,000 for factory overhead, 5,000, so no variance. So the total variance is 10 plus 10 plus 3, 23,000 favorable, because your actual cost, $165,000, was less than your, actual cost, $142,000 is less than your budgeted cost, $165,000. So you have favorable variances. Now the problem is that, yes, our actual cost is less than budgeted cost. Are we doing a great job? Why we have those variances? The problem is we won't be able to interpret those variances as a favorable as it looks. Yes, we incurred less cost, but we also produce less unit too. All right. So what do? How do we figure out what is wrong with this? We need to analyze it. How do we analyze? Well, I'm going to discuss this later on. But first thing is that once we analyze, we'll be able to find out how much of the variances are caused by low level of activity. So if we have a $10,000 variance in material, how much is due to the 4,000 less unit we produce, and how much is due to good cost control? All right, as variances can be caused by other reasons than just the activity level. So is the variance, the good variance, due to the lower level of activity because we produce less? So obviously it's going to cost us less. We use less material, less labor, right? Or is it because we have a good cost control, means the material cost that we incurred was less, not because of we produce less unit, but because we probably have a good negotiation skill, we get a great price, or we were more efficient and we didn't break as much material, and due to which we have a saving, and that's why we have a good variance. All right, so how do we figure that out, if it's due to a favorable variance is due to the lower level of activity or good cost control? Well, if you want to find that out, then you have to transform the static budget into a flexible budget, right? We've prepared flexible budget at actual level of activity. So your static budget was based on the budgeted level of activity, 20,000. So what we are going to do is we are going to switch it into a flexible budget, and the flexible budget is prepared at an actual level of activity. It's an estimate of what revenues and cost should have been at the actual level of activity. All right, what revenues and costs should have been. So let's look at this. This diagram shows you how we can create a variance, and we can come back to our flexible budget. So our static budget variance gives us two variances. One is known as activity variance. Activity variance is also known as sales volume variance. So that means this variance, the activity variance, is going to provide you a variance due to higher or lower level of activity. Remember, we are looking for two things. We are looking for how much of this favorable cost variance is due to low level of activity, how much is due to the good cost control, right? So in this diagram, we have both. Activity variance or sales volume variance is going to give you the variance due to lower or higher level of activity. And on the other side, the revenue and spending variance, also known as flexible budget variance, is going to give you the variance due to good or poor cost control, right? If you have a positive variance, good cost control; negative, it's a poor cost control. So revenue or spending, revenue if you sell, spending when you incur cost, variance are going to give you the variances due to good or bad cost control. Combining those two variances, revenue and spending variance and activity variance, when you add them together, this becomes a static budget variance, the total variance, right? So how do you calculate the sales volume variance or flexible budget variance? Okay, so we already have a static budget that we produce at the beginning of the period. We also have actual results that we have gotten at the end of the period. So flexible budget is a combination of these two. So what we are going to do, because flexible budget is prepared at the actual level of activity, so we are going to take the actual activity from actual results and we are going to use that. So that means quantity is coming from here or activity level is coming from your actual result. So if the actual result shows 16,000 level of activity, which is right here, 16,000 units, then 16,000 will be here. Then from static budget, we are going to take the price, the dollar amount, the cost, right? Because static budget is also a combination of the quantity, which is in this case 20,000, and the cost, right? But this cost has driven from the price. There is definitely per unit price for material you have paid. That's how you get 80,000. So it's a combination of those two. So we are going to grab the price portion from here and then the unit portion from here and combine them together, make a flexible budget. All right. So the difference between your flexible budget and static budget will give you activity variance, static minus flexible. The difference between your flexible budget and actual results will give you your flexible budget or revenue and spending variance. All right. So the sum of these and the difference between your actual and static, which we originally saw as a static budget variance. So if you can see right here, it says a static budget variance, which is difference between static and actual result. Now, this is like comparing apple and oranges when you prepare a static budget variance. Why static budget is an apple and oranges? Because in a static budget, you have a budgeted price and you have a budgeted quantity. In actual results, you have an actual price and actual quantity, right? So all those four elements are different. In order to compare, you have to have at least one thing in common. Either the quantity should be the same, both sides, or at least the price should be the same. If all four elements are different, standard price or static price, and then static budget units, actual price and the actual budget units, they are all four different things, then you cannot compare. You're comparing apple and oranges. So that's why you create a flexible budget and compare your actual results with flexible or static results with flexible. Because here you're going to have units common. You take units from here and input here. So you have units common. Here you're going to have a price common because you take price from here and put it here. And you will see when we do, when we continue with the example that we are doing. All right, so let's move on to our first variance here. This one, we are going to do this one first, revenue and spending variance. As you can see on the right hand side, now it shows revenue and spending variance, right? So first we are going to do flexible budget. So flexible budget, what it does is it takes your actual units from your actual results. All right, so we are going to use the actual units from the actual result side. So remember, we take actual units and we take price from here, from the static budget. And the price from static budget are those 4, 3, and 0.5. This is the price. How do we get those price? If you go back to our original budget, static budget, you will see that material is 80,000. If you divide 80,000 by 20, that's $4, or $4 times 20 is 80,000, right? 60,000 divided by 20,000 is $3, or $3 times 20,000 is 60,000. 10,000 divided by 20,000 is 0.5. So that's how we got, so we back solved it to get the price for per unit of an item, right? So we got price per unit of an item as 4, 3, and 0.5. A total of this is 750. Now, instead of using 20,000 units, which originally we have in question here, we have 20,000 units in a static budget. If you can see here, we are going to use the 16,000 here from the actual results. 16,000 units. Everything else is copied from your actual results. Everything else has not changed. Okay. So now this is the flexible budget, right? Is prepared for the actual level of activity. In the next step, we are going to multiply 4 times 16,000 to get materials price, 3 times 16,000 to get labor, 0.5 times 16,000 to get variable manufacturing overhead. So you will see here 4 times 16 is 64,000. 3 times 16 is 48,000. 0.5 times 16 is 8,000, right? There is no change in fixed factory overhead because it's fixed in the relevant range. So we copied 10,000 and 5,000 as it is. Now, if you look at that, the units are the same, unlike the static budget where you had 20,000 in static budget, 16,000 in actual, and there was 4,000 favorable variance. No, because now our activity level is same, right? We need to have one thing common. Our activity level is 16,000. It's the same. So there is no variance. So 64,000 minus 74,000. Now the actual results said you spent 70,000, right? Flexible budget is what? What should have been, right? Remember what flexible budget says. Flexible budget is what revenues and costs should have been given the actual level of activity for the period. So in this case, your revenue, your flexible budget says your material cost should have been 64,000, but you actually incur 70,000. So at 16,000 units, because you have a low level of activity, your cost should have been at 64,000. So you incurred a lot more than you should have. So that's 6,000 unfavorable. Same is with the direct labor. Your cost should have been $48,000, but you incur $50,000. Again, unfavorable. All right, the only thing that came out favorable was variable manufacturing overhead, where the actual results show 7,000 and flexible budget shows 8,000. So that means that your actual results are better, right? It should have been 8,000, but you spent less, so 7,000, so $1,000 favorable result. So basically that's a 7,000 unfavorable. 6 plus 2, 8 minus 1 is 7,000. Total is 7,000 unfavorable revenue and spending variance. So we created our first variance. This side is a revenue and spending variance, or flexible budget variance says that we have 6,000 of material variance due to poor cost control, 2,000 of labor variance due to poor cost control, 1,000 of variable manufacturing overhead favorable variance due to good cost control because it's favorable, right? In overall, we have 7,000 of unfavorable variance due to poor cost control. Now the next we are going to move on to the activity variance. Activity variance is also known as sales volume variance. All right. So that is a difference between your flexible budget and static budget, right? So we are going to copy the whole static budget from our original item, and flexible budget we already created here. So we are going to use this flexible budget amount here. So flexible budget stays there. And if you see, static budget is based on 20,000 units, right? If you see here, now we don't have units in common. 16,000, 20,000 are not common. So we have 40,000 volume variance. Whereas the price now is going to be the same. 64 divided by 16,000 is 4. 80,000 divided by 20,000 is also 4. 60 divided by 20 is 3. 48 divided by 16 is 3. So now the price is common, unit is not common. Previously here, The units are not common. Units are common, but the price is not. 64 divided by 16 is 4, but 70 divided by 16 is not 4. 50 divided by 16 is not 3. 48 divided by 16 is 3. So here the price is not common. In activity variance or sales volume variance, our price is common. Okay. So now this variance is due to the lower level of activity, because it shows here we have 4,000 lower level of activity. So the static budget says that you should have incurred $80,000, but flexible budget says that $64,000. So you have $16,000 favorable variance, 80,000 budgeted amount and 64,000 flexible budget amount. Same is with the direct material. And direct labor is $12,000. Static budget says expected use 60,000 to incur, and 48,000 showed by flexible budget, and variable MOH 2,000 favorable variance. So all those activity variances are favorable. So that adds up to 30,000. 30,000 here. Now remember, we have 7,000 unfavorable variance. If you subtract 30,000 from 7,000, the total you will get is 23,000, right? And that's what I said here in this diagram, that revenue plus spending variance is a static budget variance. And you have seen that when you add minus 7,000 to plus 30,000, you will get 23,000, which was our static budget variance. Now, how the flexible budget performance report looks like, that looks like this, right? You have a static budget right there that was given at 20,000 level. Okay. You have actual results on the corner right there on the right hand side at 16,000 level, and in the middle you have flexible budget that you prepared at 16,000. So we have already done this. We have just combined them in one report, right? And here are the differences. So the difference between flexible budget and static budget is known as sales volume variance or activity variance. That's in the middle, 30,000. This is just what we have done right here, $30,000. And then the difference between your flexible budget and actual results is revenue and spending variance. That was $7,000. That's revenue and spending variance we have found out here. Okay. So we combined them together, and the sum or difference between these two is 30 minus 7 is 23, is the static budget variance. So that's how you prepare a flexible budget performance report. You can put both static and actual results together, and in the middle you can put flexible budget, and then take differences between actual and flexible and static and flexible to come up with the revenue and spending variance and the sales volume variance. Now, what are the advantages of the flexible budget? Now, flexible budget shows revenues and expenses that should have been occurred at the actual level of activity, because the actual level of activity is not known until the end of the period. And when you prepare your static budget or a planning budget, you prepare at the beginning of the period, and it may differ towards the end of the period. And if it differs from the towards the end of the period, you budgeted 20,000, it came out 16,000, then you won't be able to compare then, because you are comparing apple and oranges. So you have to adjust the static budget at the actual level of activity. Okay. So then you create a flexible budget. So that's why it shows you the revenues and expenses that should have been at actual level of activity. It can be prepared for any level of activity within relevant range. So even if you prepared a budget for 20,000, now you can adjust at 19,000, 16,000, 15,000, 15,235, any level of activity, you can adjust your flexible budget, and then you can compare. It also reveals revenues and the variances due to good or bad cost control, or due to higher or lower level of activity. So the static budget variance, originally it was not showing you whether the variance was due to good cost control or due to higher or lower level of activity. But when you change this into a flexible budget and you take a differences between flexible and actual and flexible and static, now you can tell how much of the variance is due to good cost control or poor cost control, and how much is due to a higher level of activity or lower level of activity. And once you have that information, you can improve the performance. It helps you in performance evaluation, that whether managers are performing good job or not. Otherwise you'll be comparing apple and oranges and you wouldn't know if they're performing a good job or not. And that completes the flexible budgets. Thank you for watching my video. Please subscribe my channel for live updates.